Happy New Year, everybody, and welcome to the Property Podcast. We are motivated. I hope you are too. 2018 is going to be a good one. I can feel it in my bones. And we are starting strong this year. We are starting with what might be the most popular episode we do all year. Finally, we tackle tax.
Yes, Happy New Year to you. Thank you for joining us once again. We're going to spare you our rendition of Auld Lang Syne and get straight into it because we've got so much to get through. We're starting strongly. We've got a great news story. We've got a great resource of the week. And as Rob said, we've got a great main topic with a very special guest where we're going to be tackling the topics that you've been asking about for years. Before all that though, this is not just the first episode of the year, it's also the first Thursday of the month. What does that mean? You should know by now. It means Property Hub meetups. It means more than 30 opportunities all around the country to go and kick off your year by meeting friendly property investors, get motivated, get advice, and generally get yourself going. If you've booked your place already, fantastic. I'm sure you'll have a great time. If not, it's not too late as long as you are listening to this on the day it comes out, which you always should. If that's the case, you just need to get over to thepropertyhub.net/meetups, book your place there, completely free. Why wouldn't you? Now, normally the fact that meetups are happening tonight would be the most exciting thing that we've got to talk about today. But Rob, today is not an ordinary day.
Today is not an ordinary day. Today is a very, very exciting day. Yes, we are joined by Russell Smith, tax extraordinaire, who's going to take us through all sorts of wonderful things. But we've gone one step further with Russell. No, we're not in a relationship. Well, actually, we are in a relationship. We're in a business relationship. As we mentioned last week, we have launched Property Hub Tax. We are super excited because you want it. You've made us do this. This is your fault why we look so old, because you've asked us time and time again to recommend somebody who can help you with your tax affairs, particularly with property, because it is so complex. There is so much happening, and people are just worried that their tax affairs aren't in order. And to be honest, they're probably not. And today's episode is going to go a long way to helping you with that, to identify if you're doing the right thing or not. But of course, Rob, we don't do things by halves, so we set up a new business.
Yeah, this is so important to so many people that, if you want a job doing properly, do it yourself. We couldn't help getting involved. And we've set this up very specifically to make sure that you get what you need out of it. Because you can get someone who'll submit tax returns for you, fine. If you're lucky, they might tell you about a couple of allowances you didn't know about to save yourself a bit of money. Great. But what you never get with accountants is somebody who's looking at what you want to achieve in the long term and is going to come up with a structure for you that will minimize the amount of tax that you pay over the years, over the long term, to make sure that tax takes the smallest possible bite out of what you're trying to achieve as you progress towards your goals. So we've set this up in a way that makes sure you're getting the best tax advice for the long term, for what you personally are trying to achieve, not something generic, for you right from the start. The way that we do that is with a consultation. That's where you answer a whole bunch of questions in advance, then you sit down for 45 minutes with your accountant and you actually do a screen share with them. They put all your information up on their screen, they put it into a spreadsheet, and you work with them as they show you the effect that different decisions will have. So should you be in a limited company or not? Should you be looking to switch some ownership over to your spouse? They will actually be doing this on screen and showing you the effect that those decisions will have over time while you're watching to make sure that you really understand it. After that, they'll follow up with a super detailed report giving you the breakdown of all the worked figures behind that, and then you can do a couple of different things. You can either give that to any accountant and say, there you go, that's what I'd like you to do for me, please, and they'll go and do it. Or what I think you'll probably end up doing is working with Property Hub Tax over the long term because you've seen what they can do and you'll realise if that's what they can do in 45 minutes, imagine what they can do as your accountant year in, year out. Nobody else does it this way, but we've done this because we know how important this is for property investors and we know what you need in order to turn tax from what it is now, which is a huge headache for everyone, into something that you're confident about, you've got sorted and under control.
Now, that consultation is only £300 plus VAT. And when you take into consideration, this isn't a few tax tips, this is a personal strategy for yourself. That is phenomenal value, absolutely phenomenal. Now, we know there's a lot of you, and we know that this is a new business. And from past experiences, we've found that when we launch something new, you are amazing, you support it, you want to get involved, and you trust what we do and the products and services we provide. But because of that, we have to start small. So we are opening up only 75 slots. And that 75 slots you can book in across January, February and March, and there's 75 in total. Now, we're not letting people book in to April and beyond right now because this is a new service and we don't want to be overwhelmed. We want to deliver an amazing service. So once those 75 places are taken, which I don't think will be too long based on the amount of emails we get asking us about tax, then we will provide a waiting list for you. But if you are keen and you have wanted this, which I know many of you have, then get along to propertyhub.net/tax and get one of those 75 places.
Yep, if you want to make 2018 the year when you get started in property or where you really scale up in property and start achieving what you really want to achieve, you've got to sort your tax situation out first. It's absolutely essential. So what better timing is there? Just get over to thepropertyhub.net/tax while those places are still there. So Rob, we're going to be sitting down with Russell in a moment to keep on talking tax, but I feel a bit excited. I think we need a little bit of a break first. Shall we have a news story?
Are you saying news stories aren't exciting, Rob? Well, I always get excited by news stories where people agree with us. And yes, we do pick them, so it's easy to do. But it's this time of year. We've done our predictions for 2018. Make sure you listen to that episode. It was a good in. And you can find out what we think we've got in store for the year. But the industry experts as well, they've had their say. And Rob, it seems that they're in agreement with us. Or we're in agreement with them, however you like to look at it.
I like the first way. I'm sure what they did was they just listened to the episode and then they copied us and brought out their predictions afterwards. I'm confident that's how things panned out. But yeah, we've got a review here from a estate agent today that rounds up a lot of the different predictions, and they're all pretty much in line with what we said. So the most bullish is probably PwC. They reckon an annual rise of 4%. The Office for Budget Responsibility says 3.1%. A lot, though, are saying only 1%. JLL, Nationwide, Rightmove and Savills are all saying only 1%. So that's very much in line with what we were saying, possibly even a little bit more negative than what we were saying, but definitely doesn't look like being a bumper year.
No, it doesn't. So we can all come back and laugh at ourselves and everyone else in a year's time if it has been a bumper year. We shall see. So Rob, we can't hold back any further. We have a very, very special guest on this week. A guy who is as enthusiastic about his subject as we are about ours. Yes, we have on a show, and won't be for the last time, Russell Smith.
So Russell, thank you so much for joining us. We know that you've got to pay tax on the money you make in property. We've kind of reconciled ourselves with that, but it's worth just starting with the real basics. Like, what types of tax are they that you need to pay? So there's lots of taxes. There's income tax, corporation tax, capital gains tax, inheritance tax. What do property investors have to pay, and at what sort of time do they kick in?
Yeah, sure. So I guess the main property tax that you pay depends on whether you've got property in your own name or property in a limited company. So I'll start with property in your own name. If you've got property in your own name, you're going to be paying income tax. You'll pay it on your profits from your rent. Okay, so you're going to have rental income minus your costs, and that will equal your profit, and that's what you pay tax on, and that's income tax. Now, generally speaking, you pay income tax as a property investor on the 31st of January. However, if your tax bill is over £1,000, you end up paying it twice a year, once on the 31st of January and once on the 31st of July. So kind of half each for the whole year. So that's income tax. The other big tax that you'd pay as an individual investor is capital gains tax. Now, capital gains tax happens when you sell one of your properties. So not your primary residence, but sell one of your buy-to-lets, you'll pay capital gains tax. And essentially, capital gains tax is on the profit, or technical term gain, of the property. So essentially, it's the sales proceeds of the property sale minus your original cost equals your gain, and then you basically pay capital gains tax on that. Now, you actually pay capital gains tax on the same time that you pay income tax. So essentially, it's kind of worth planning for. But in terms of the actual level that you pay on capital gains tax, it's actually 28%. If you're a high rate payer, and 18% if you're a basic rate payer. So that's capital gains tax. Now, the other taxes that kick in is essentially VAT. So if you've got professional fees in the running of your rental income business, you will essentially pay VAT on those fees as well. And if you're a limited company, rather than paying income tax on the profits, you pay corporation tax. So essentially, it's the same sort of principle. Your rental income minus your costs equals your profits. That's what you pay corporation tax on. So same idea as the income tax. The only twist with limited companies is that actually you end up paying corporation tax on the profits, but when you take money out of the limited company, you could still pay income tax, what I call the dividend tax, so tax on your dividends. You do get £5,000 free at the moment, but ultimately you would pay more income tax. So far we've got income tax, corporation tax, capital gains tax, VAT, and the other big one that I'm missing out, which everyone who's in property investment will pay, is stamp duty land tax. So essentially you pay that when you buy properties. And as you probably know, since the beginning of 5th of April 2017, stamp duty has gone up with an additional 3% on everything. So generally, it's very difficult to get around stamp duty these days. If you buy something lower than £40,000, there'll be no stamp duty, but anything over that, there'll be a minimum of 3% and 5% over properties worth 125,000 or over. So there's the 5 taxes that you pay.
And Russell, if that wasn't enough, that is plenty of tax, but if that wasn't enough, then some people also have to take into consideration, especially if they're building wealth, inheritance tax.
Inheritance tax. Okay, so this is one that most people worry about, but in reality, only 1% of the population will actually pay. And the reason for that is, if you are married, well, if you're not married, you get £325,000 free of inheritance tax. But if you're married, you double it up and you get £650,000. Now that's actually going to be increasing to £1 million. So technically speaking, if your wealth, so by wealth I mean the market value of your properties minus your mortgages, your actual equity, your total wealth is less than £1 million, inheritance tax is a non-issue. Okay, so you don't have to worry about it. If you're over £1 million, you totally have to worry about it. And essentially, inheritance tax is paying 40% on everything that you have over £1 million. And the biggest thing that's relevant to property investment is that if you're a normal business owner, you get a thing called business property relief, which essentially takes your business out of your estate. Basically, you don't pay tax on it. However, property investment businesses do not count for this. So if you do have properties over £1 million, you will pay 40%. So it's worth planning for.
Super. Okay. So that's taxes. Next up, Russell, something that people always get confused over is capital expenses versus revenue expenses. First of all, what are they? But also, can you start to explain the differences between the two?
Yeah, sure. I mean, I think the words capital and revenue are quite confusing. So essentially, I kind of think of them as big or small. Okay, so big expenses can be things like, you're buying, you're having a capital replacement for your property. So let's suppose you're putting in a new a big kitchen or fixtures that are actually going to be part of the property themselves. The biggest capital cost, as in the big cost, is the actual property itself. And the difference between the big capital costs are that you don't generally offset those costs against your regular rental income. That's the big difference. So if you were going to buy a big property, you don't ever get relief from tax from that until you actually sell that property. And it's not just the property cost itself, it's all the costs associated with that. So stamp duty, valuation fees, any professional solicitors fees, even accountancy fees related to the property purchase would all be dumped in capital. Now it's not great because if it gets dumped in capital, i.e. these big costs, it means that you don't ever get tax deduction for these until you actually sell the property, which could be 10, 20 years down the line. So it's in people's interest to make sure they do identify expenses as not capital costs. Now, the technical term is revenue expenses, but I do find that a bit strange word because revenue we think of as income, not outgoings. But essentially, revenue expenses is everything else. So for a property investor, it's going to be letting agent fees, accountancy fees. It's going to be repairs, renewals, that sort of thing. It's going to be ongoing costs to do with the ongoing running of the property. So if you think capital, it's kind of when you purchase the property and the kind of big stuff, maybe altering the property, maybe it's the fixtures of the property, and the small stuff, the ongoing stuff, is revenue expenses. Now, of course, if you can put stuff in revenue expenses, that means that you get tax deduction in the year of the rental income. So very, very important.
Now, an area where I suppose it's a bit of a grey area, investors often struggle with this, is the issue of improvements versus repairs. One of those is a capital cost that you have to wait until you sell the property to get it back. The other is a revenue cost, which we now know we'd rather have because you can use that to reduce our tax bill in the current year. Which is which, Russell? And how do you know when something is an improvement versus a repair?
Well, this is interesting because a grey area has just got even greyer. Because before you had something called a wear and tear allowance. And essentially that meant that we didn't really have to bother thinking about repairs. All we needed to do was, if we had a furnished property, we could just deduct a 10% cost, 10% times the rental income every year, call it wear and tear, chuck it in our tax return and get tax deduction for it. Quite useful, actually. And to be fair, it was actually quite generous because essentially if you didn't actually repair anything, you could still claim it every year. Now, unfortunately, with all the other changes in property investment tax, this changed as well. So now we're in a very, very strange situation, okay? So essentially, repairs are replacements. I think the word replacement is a better word because essentially if you've got a property and you're replacing things, then you can essentially claim the deduction for that every year. But it's now got to be a basis of fact. It can't be wear and tear. It can't be a kind of group of expenses. It actually has to happen. But here's where it gets a bit strange. If you've got a decent TV, say £300, a £300 TV in your property, and you then start to replace it with a £1,000 TV, really you can only claim the cost of replacing it, so £300 TV, rather than the £1,000, because technically a £1,000 TV is an improvement of a £300 TV, and an improvement means capital. A capital expense means you can't claim the tax deduction on it until you sell the property. So it's obviously in your interest to get as many things in revenue expenses, but you're going to have to do some work now where you didn't before. Before you could lump it into wear and tear, now you're going to really have to look at whether everything that you actually spend is a improvement or repair. And, you know, the TV example is an easy one because it's £1,000, it's £300, that's clearly an improvement. But in other expenses, it's going to get a bit more greyer. The way that I would do this is step one, you want to get as many things in revenue expenses as you can. So many things into your tax return to deduct from your rental income. Step two, if you are unsure, I would actually put it in the supplementary box in the tax return. So you disclose to HMRC your treatment of some of your repairs, because that means that at least you're being open and upfront and telling them what you're actually doing.
So Russell, mortgage interest relief. We've touched on it already. It's such a big subject. In fact, I can't believe we got this far without talking about it. But mortgage interest relief, it's what everybody is getting confused over. It's what everyone's really in a conundrum over on what to do with this change. First of all, can you explain what it is, please? But also, can you start to guide people on what really should they do? What are the first steps they should be taking?
Yeah, I mean, if you are worried or thinking about this change in mortgage interest, then you need to be, because this is absolutely massive. I mean, it's the biggest change in property tax, forever. And essentially, the big thing, just to cut through everything, is essentially you will pay more tax. That is the thing. And if you do nothing, you will pay more tax. That is the situation. Now, what is it actually happening? Right, mortgage interest. Mortgage interest on mortgages on your properties were up until now tax deductible. And what that mean was, when you did your tax return, you could put in your rental income and you could put down the cost of your mortgage interest. Now, for some property investors, if they had 100% interest only mortgages, they could actually deduct the full cost of their interest against their income. Now, essentially, you can't. Now, there's a few caveats to that. The first one is, you can't if you're a higher rate taxpayer. Now, by higher rate taxpayer, I mean you're earning over £45,000. That's the higher rate threshold at the moment. A lot of people will be, because property investors generally either have another income, be it employed or business income, maybe a self-employed business, maybe a limited company, and they use their extra cash to buy a property. So this is going to affect a lot of people. Now, the Chancellor says this will only affect 1 in 5 people. It seems low to me, because really, if you're a property investor, you tend to be higher rate payers. Now, if you're a higher rate payer, that essentially means you cannot deduct mortgage interest from your costs anymore. That means that your profits per your tax return are going up. The reality is the cash in your pocket is going down, because the profits you're actually making is the same, but you're going to be disclosing higher profits on your tax return, which will attract more tax. So the thing is, it's like having a load of costs and an HMRC saying, oh, you know that cost that you've always claimed on your tax return? Yeah, you can't do that anymore. So that means that your profits are going up, your tax is basically going up as well. Now, you may think to yourself, it's okay, I'm not a higher rate payer because I earn earn less than £45,000. Well, think again, make sure you've got this right, because you may earn less than £45,000 now, but if you take away the mortgage interest, as I've said, so you can't claim it anymore, just look at how much you earn. So let me give you a real quick example. Let's suppose you earn £40,000 every year, but that's after you deduct £10,000 interest. Well, now you've got to disregard the £10,000 interest and add it back. So effectively, you're now earning £50,000, which means you are dragged in to the higher rate threshold. And that's going to be happening to a lot of people. So the big deal is making sure that you know where you are. Are you a higher rate payer or are you a basic rate payer? If you're a basic rate payer, i.e. you truly are, disregarding mortgage interest, you're definitely basic rate, then there's nothing to worry about. There's no changes. You can deduct interest. It's totally fine. If you're a higher rate payer, you can't deduct mortgage interest anymore. It means that your profit is now up. Your cash is the same, but your tax is going up as well. So we need to be looking at what we can do to mitigate this.
So what can you do to mitigate this? One thing that a lot of people seem to be doing is moving into a limited company.
Yeah, so the question becomes, what do you do on future property and what do you do on your current property? So I'll answer the first one first because it's easier. If you're still going to be buying buy-to-lets, there is a huge advantage with buying in a limited company. The advantage basically is that you can deduct mortgage interest from your rental income in a limited company, just like you were doing before. So there's a huge advantage there, a huge tax advantage of buying in a limited company now. The other quick thing that is actually allows mortgage interest is furnished holiday letting. Now, you may have a load of buy-to-lets and you may not think of them as holiday houses, but it's worth looking at the criteria on furnished holiday letting, because if you can then change them to furnished holiday letting, which essentially means you need to keep them available for certain times of the year and you need to have different tenants in the year. If you can do that, then you can actually claim mortgage interest as well. So become a limited company for future properties. Maybe look at furnished holiday lettings to see whether you can actually claim mortgage interest. So when we're looking at your current property, we've got to assess how much extra tax you are going to pay and whether you need to take action. If you're going to pay £1,000 extra tax over the next 4 years, maybe you're okay, you should be fine. Put your future properties in a limited company, you're probably going to be okay. However, I've seen £25,000 extra tax in some situations. It really does depend on your portfolio and how much you are relying on mortgage interest in terms of your investment strategy. So what we do in our consultations is we actually look at people's portfolios and we say, okay, here's your portfolio. What is the tax change going to be? Is it going to be £2,000? Is it going to be £20,000? If it's going to be £20,000, we really have to try and do something. Now, there's two ways that you can kind of do something on this. Already look at your furnished holiday letting just in case that's an option. But other than that, the two big options are spouse transfer. Okay, so number one, spouse transfer. Can you transfer some of your property to your spouse? Can you equalise your income? Because essentially, if you can do that and keep you and your wife or husband below the basic rate tax, so below £45,000, then brilliant. You can claim all your mortgage interest relief. You don't have to worry about it. Fantastic. And we found that we can do that, and it's relatively straightforward to do and no real big deal, and that's totally fine. If you can't do that, or if you've already done that and you're still both in the higher rate tax, then we're looking at, okay, can we transfer our properties out of our individual names or individual name? Okay, there's two problems with this. Two taxes, unfortunately. The first being capital gains tax and the second stamp duty. If you were to transfer your property from your individual name to a limited company, you would unfortunately crystallise, it's a term that I do like to use, crystallise a capital gain. Essentially, you're going to be selling the property from your own name to a limited company, selling it to yourself, and then you're going to crystallise a gain. So effectively, you're actually going to make a profit on that property. Now, if your market value hasn't gone up that much and your gain isn't that much, then maybe we're okay. But if your gain has gone up, you may find some hefty capital gains tax bills. And just to remind you, you do get £11,000 each free on capital gains tax. So if you've just bought properties and the market value hasn't gone up too much, you might be okay. But let's say you're not. Let's say it has a huge tax bill. I would say to you then, the income tax that you're going to be paying with this new mortgage interest change is going to be about £20,000. But if you transfer the properties in your limited company, you're going to pay a capital gains tax bill of £30,000. You're going to say, well, we're not going to do that. But there is a way around capital gains tax, and it's quite interesting. It's called incorporation relief. Essentially, it gets rid completely of capital gains tax. Now, the one thing you've got to do is you've got to demonstrate to HMRC that you are a property investment business, not just one person or two people buying a bunch of property. Now, that may sound like the same thing, but there is a big difference. Incorporation relief is only open to businesses, not individual investors. So if we can demonstrate that you are a property investment business, and there's a few ways that we can kind of do this, then we can actually say we were going to claim incorporation relief and get rid of capital gains tax. Now, it is a very, very grey area. Certainly the clients that we are working on to try and claim incorporation relief, we're essentially sort of selling the case to HMRC in some cases. Sometimes it's very, very easy to prove, and sometimes it isn't. But with clients that we're doing, we're assessing whether or not it's worth going for. We are actually getting pre-clearance from HMRC, which is great, because basically we're arguing the case and seeing if they agree with us. If they agree with us, then brilliant. We get rid of capital gains tax altogether. But if they don't agree with us, well, then we're stuffed, and we've got this big capital gains tax bill, which may then mean that we don't go for it. So even if we can get around capital gains tax, we've still got one more hurdle, and that is stamp duty. Now, I said before, if you're selling a property, if you're transferring a property, it's like selling a property. So on the individual investor, you're going to have a capital gain, unless you can get around it. Now, for the limited company effectively buying the properties, you're going to have to pay stamp duty. And as I said, you're definitely going to pay it, because if it's over 40,000, you're going to at least pay 3%, probably 5% if it's over £125,000 in value. There is a way of getting around stamp duty as well, but this involves becoming a partnership. Now, you may say to me, hey, I've got a wife or a husband, we've got property together, we're already a partnership. Well, partnership means partnership tax returns. So it's not enough just to file individual tax returns. You've got to be a partnership and actually submit partnership tax returns. Now, in my experience at the moment, that's actually very few and far between people. Husband and wife teams, or civil partnerships, or whoever have got property, they tend to file individual tax returns. So you've got to become a partnership. Now, you may say to me, well, what's this partnership business? Well, the reason why you become a partnership is because you can transfer properties to a limited company from from a partnership and not pay stamp duty. That's why we do it. So essentially, if you can get around capital gains tax and stamp duty, which some people will be able to do, you basically can transfer your existing portfolio to a limited company and effectively save loads of tax. But you've got to look at your portfolio first to see how much this new change, this Section 24 mortgage interest change, is actually going to affect you.
Well, now you can see why we got so excited about working with Russell. Russell's knowledge is vast, and he's just started. And the great thing is there's more next week in next week's podcast, which we'll talk about shortly. But this is the wonderful thing. Because we've launched this business, we can now produce even more and more content around tax. So we'll give it away all free. We'll tell you how to do it. But if you want that advice, if you want that extra bit of help, you know that we've got you covered at thepropertyhub.net/tax. And don't worry, we're not going to be talking about it every single week, because we don't do that with the other businesses. You'll have to indulge us this once, because we are really excited. Months and months and months of work have gone in to getting to this point. And we're really excited to see your response to it, because we know you've wanted it. So we hope you love it as much as we've loved building it. But as I say, loads of content off the back of it.
Okay, so new year, time of change. Everyone's very excited about what they're going to do differently this year. One thing that we're absolutely not going to do differently is read out a 5-star review every single week. So Rob, who have we got to kick us off?
We have Diana. A huge thank you to you. I've been listening to these two for a couple of years now, and every time my investment journey gets a bit tougher, I listen to a podcast and immediately feel inspired to keep going. Their straight-talking, humorous way of delivery makes absorbing their info interesting and fun. Thank you, well done, and keep doing what you're doing. Well, thank you, Diana. Thank you so much for your review.
Okay, so resource of the week time. And our pick for this week is Momentum. No, not the political organisation. It's an app that helps you with something far more important than mere politics. It helps you with habits. Habits are so important. The brilliant thing about a habit is that once it becomes automatic, you don't need to even try anymore. It just happens. So unfortunately, that's the case with bad habits as well. You can find yourself habitually doing things that are unhelpful, but you can easily flip that round and start doing things that are really beneficial to you without needing any willpower whatsoever. So this is where everyone goes wrong with New Year's resolutions. They get all excited about something. They think, great, this is going to be different. I'm going to change this. And for a couple of weeks, they'll make a big effort relying on lots of willpower, but then that willpower runs out and the whole thing goes back to how it was before. If they just built a habit instead, then they could have kept on going with whatever it was they wanted to do without having to burn any energy on it whatsoever. It would just happen. Now, the time when a habit is most vulnerable, of course, is when you're first getting it set up. And there's lots of research that shows if you can just do something for 60 days, 60 days tends to be around about the key time. After that, if you've managed to keep it up for that period of time, it becomes automatic and you don't have to think about it anymore. So there's loads of apps that help you establish and track your habits. They're all pretty similar. It's all a way of setting what you want to do and just ticking it off each day so you get motivated by seeing the chain of days and not wanting to break that chain. Momentum, which is available for the iPhone, just makes that super duper easy. Really easy to track. You can track and update without even having to unlock your phone. You can do it right there on the default view. And it looks really great as well, which does help. It makes you feel more motivated to go and update it every day. So momentum.cc is the website. We'll link to it in the show notes. Perfect time of year for this resource of the week.
Absolutely. Habits plus goal setting. Well, if you combine those two, you're going to be a very, very successful individual. And you know what will make you more successful, Rob? Listening to the Property Podcast next week. And listening to Ask Rob and Rob, because that's back as well. Hooray!
Yes, of course. We are keeping the tax theme going because we can't just fit it into a single week. So next week we are going even deeper. We've got Russell back with us again. Now we've covered off the basics, we're going to get into detail on some really important areas of property tax. And it doesn't end there. We've got some tax-themed episodes of Ask Rob and Rob coming up throughout January. But now Ask Rob and Rob is back for the new year. If you've got any questions at all, doesn't have to be about tax, can be about anything you like, then just go over to thepropertyhub.net/ask and get your question in.
I think by the end of January, Rob, we're going to have thousands of people who are experts on tax for this content. Hopefully, that's the plan anyway.
Yep, that is the plan. So I hope you enjoyed today's episode. Thank you for joining us. Happy New Year once again, and we'll see you next week. Bye-bye.
Bye-bye.
Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.